Okay, welcome back everyone, and I am delighted to say we're continuing our Microcap Fund Manager interview series. I think this is our sixth interview we've done in recent weeks with some fund managers operating in the space, and we've got our third listed investment company manager joining us this morning, Gregg Taylor from the Salter Brothers Emerging Companies Limited. Greg, how are you?
Yeah, well, thank you, Mark. Hello, everybody.
Uh, Greg, for anybody who maybe hasn't come across this particular LIC or yourself in the media and elsewhere, maybe just give us an overview of yourself, the fund, and its kind of underlying investment strategy.
Yeah, absolutely. So, hello again. We've got Gregg Taylor, Portfolio Manager at Salter Brothers Equities. Salter Brothers is a $3 billion alternative asset manager, focusing across a number of alternate asset classes, including equities, in small caps, both listed and unlisted. So, the product we're talking and referencing today is the SB2 Emerging Companies Listed Investment Company. So SB2 is the ASX code, and it's a listed investment company that focuses in microcaps very much so. So the mandate is for companies with a market capitalisation of less than $500 million. And so we've created a diversified portfolio of industrial exposures there. So just clarifying, we tend not to invest in the resource or biotech sector. So typically looking for industrial focused companies, sub 500 mil market capitalisation. We do have somewhat of a growth focus in our investment approach. So looking for businesses with revenue growth, strong intellectual property, really about identifying and backing strong management teams, and again really just having a point of difference and a path to scale, which is critical in this end of the market. So for me personally, I've been investing in the small and micro cap market for over 25 years now. So it's something I'm very passionate about and enjoy. And again, the SB2 vehicle is interesting in that it is a listed investment company. It does provide a diversified exposure to this end of the market by a professionally very deep, experienced management team. And as with a number of these listed investment companies, it does trade at a discount to the underlying asset value. So there's that extra upside opportunity, should that discount close over time. So that's us. I think I'll just open real briefly on the broader macro environment for microcaps. And again, I sort of touched on, I've been investing in from an institutional basis for 25 years in this end of the market. And I'd say the last couple of years has been as tough as it's been over that 25-year period. Though, notwithstanding that, there's always interesting opportunities at microcap end of the market. But as a whole, I really strongly and increasingly believe that the risk versus reward in this end of the market is as good as it's been over the last 25 years. And you can look at a number of metrics from discount valuations to the ASX 100, or even just the broader small cap end of the market. So small caps are all grouped together, but majority of small cap performance that drives these small cap indices are sort of companies that are 1 to 2 to up to $3 billion market capitalisation, and they're very much not the micro caps. So really believe we're at historic bottoms here and not calling the turnaround tomorrow. But what is encouraging is there are some early green shoots, and they're only a couple of weeks in, but you've seen the Russell 2000 out of the US, quite a market turnaround, and after a couple of years of pretty consistent underperformance, it's really bounced back pretty aggressively, and you're starting to see that in the Australian smaller end of the market as well, with November seeing the small cap market up 7%, which is the best performance we've had for a long time. Unfortunately, it didn't flow all the way through to the micro cap market end quite as yet. Still had a positive month, but not to that extent. But it really feels like a bit of volume and sentiment starting to come back in. And again, the fundamentals of this end of the market are as good as they've been for a long time. Balance sheets are back in shape. Businesses and management teams have got their act together. They built sustainable business models. They've learned to live within their means, and there's still great growth opportunities available. So I'm excited today to talk about a couple of those growth opportunities, and really looking forward to the discussion today, Mark.
Yeah, and I think all of the managers, I think we mightn't have mentioned it in the interviews, but I think kind of off air chatting before we got going on the interviews, everybody was kind of saying the same thing. We're at kind of GFC style lows valuations, and people are looking at things and finding a lot of exciting opportunities, as many as they've found since guys who've been around since those GFC days, that the opportunity set hasn't looked as good or as broad in the best part of 15 years in the microcap space. So I'll just add that in there. Yeah, all our portfolio managers, we mightn't mention it in the interview, but I think everybody is kind of seeing the same thing. And if you're kind of taking a 5-year forward view from today, I think, as you say, the risk reward opportunity really does look interesting at this point in time. But let's move away from the macro and get down into some actual stock selections. And funnily enough, what I want you chose just actually presented last week, and I'll put a link in the show notes below to it was actually Sam Riley from Ansarada who presented at our Coffee Microcaps morning meeting last week. And this is a business been around for a while now. I think it's listed like 4 or 5 years now at this point. But for anybody who maybe not aware of Ansarada or didn't catch Sam's presentation last week, maybe just give people, Greg, an overview of what Ansarada does, because there's a funny story behind the name, and it doesn't really lend itself to explaining what they actually do.
Yeah, absolutely. So Ansarada is a $150 million microcaps. They're listed on the ASX, and ultimately it's known for predominantly being providing the software that runs and empowers the virtual data rooms for capital transactions in the global market. So think about IPOs, mergers, acquisitions, secondary transactions. This is the software that creates the data rooms that runs that, and many of the major investment banks and funds management houses, and both listed and unlisted capital markets are prolific users of this software, and are highly dependent on it. In saying that, it has done a great job over the last few years in diversifying its business beyond just pure capital market transaction data room software, and does a lot around the ESG and risk management and governance side of things. I'll talk a little bit about that later, but ultimately the business is known for it's virtual data rooms. And again, just to really simplify that, that's when a business might be considering a major capital transaction, all their documents are stored for the various service providers and stakeholders to review in this virtual data room, and makes the sharing of information and those capital processes a lot more efficient. And importantly, in this day and age, around security and confidentiality as well. So they do a great job of that. And what has attracted us to Ansarada is that it's a business that, again, is ultimately driven by capital market activity still. And if you look over the FY23 year, capital market transactions were down 50%. So when that's the major driver of your business, and the broader environment or the macro environment's down 50%, is as tough as it gets. And despite that environment, this business still delivered an underlying EBITDA positive result, delivered positive cash flow, and grew its revenues. Pretty amazing result, and I think that's a reflection of just the broader growth opportunity they're still yet to penetrate. So despite that dramatic market environment, they can still win market share and win through there. But it was also the diversification of their business into a couple of other really big macro themes that I think will become quite a big part of this business going forward. And I was talking about the ESG, which we talk about in almost every conversation now for corporates globally, which is driven by regulation and just broader risk and governance controls the regulation and reporting requirements around that now is as significant as a major capital transaction and requires similar functionality to a virtual data room. So Ansarada have done a great job in diversifying their business into those means and getting some great traction in the market, both domestically and globally. So again, I think for me, we spend a lot of time assessing management and backing management teams, and the ability for a management team to assess the broader environment and pivot and focus their business accordingly is a unique skill set that's not shared by many, unfortunately. And I really think Sam and the team have done a great job of that. And I think the real opportunity is that growth will continue in the non-deal side of the business. But again, if you look at cycles and more normalized environment for capital markets over the next couple of years, these guys are going to have some pretty meaningful growth just in the broader market from where the levels are today. So lots of good drivers of growth, well-managed team, great software, and big global growth opportunity for a business that again, generates cash, has $22 million of cash on its balance sheet. So we're very well funded. It's not burning cash, and trades on what I'd call bottom of the cycle or below mid-cycle earnings. Trades on really attractive earnings multiples. So our view is there's conservatively greater than 50% upside in this story in over the next 12 months. And if you take a longer term view and their longer term vision around what they have articulated to the market they can deliver with this business, it could increase multiples of its current valuation.
And if we just talk about maybe risks to the business going forward, Greg, or things you're kind of worried about, would the key one be that the pumping money into these like new products, government tenders is another one. I think Sam called out as a kind of a subset of compliance on its own that they're kind of looking at, and then there's kind of board company ESG and a few other areas that they're looking at. Is kind of one of the main risks. They're doing all this kind of product development, software development, and it just doesn't have the right market fit, or people just don't kind of latch onto it as successful as their M&A product could be. And we get 12, 18, 24 months down the line, and they're like, no, we're going to have to shut down this division or this product, and take a big write down on the kind of investment in software and product development that they've done. Is that kind of the key risk that you would see for Ansarada, or is there anything else that kind of keeps you kind of awake at night when it comes to Ansarada?
Yeah, look, I think you raise a good point there, but ultimately, again, if you look at some of the great tech stories and unicorns and all that story, they've been forced to pivot and diversify their business through time. And it's the ability of the management team to read the environment and make those strategic calls. And that what I like about the Ansarada model is that one, it's now got to the point where it's self-funding. So yes, they are taking investment risks, but they've got the balance sheet to do that. And I define that as the right to take these strategic moves. And so it's very much about backing them. And to date, they've had a good track record of identifying these opportunities and executing it. But the other interesting part, which gives you some confidence about these strategies, is that they adopt this freemium model to revenue. And what that enables them to do is, and as the name suggests, it enables users to get onto the platform and start using it on a free basis. And then when they get to needing more functionality and requirement, or they go deeper into a transaction or tender or whatever they may be doing, that they switch to the paid model. So it gives them a really good forward look at their pipeline and what's happening. And so I think, and if you speak to management, they've had a really good track record of being able to look forward 6 and 12 months around what their customers are doing or gearing up to do. So I'd argue they have good visibility of their customers' behavior and what they're preparing for, and that somewhat de-risks that. But absolutely, it's a risk. But again, the core functionality of the tech and the platform's been built, so you don't have a huge product risk. And these, a bit easier to pivot in and out of markets. And again, they're very granular with their marketing spend and their growth spend. And they, again, of all the companies at this end of the market, they're one of the best in giving you their growth metrics about what returns they're getting, what they're spending per customer, what return they're getting, and what their tolerance ranges are. So our observation is they've got great risk management controls in their business that somewhat reduces that risk, but absolutely that risk remains. So look, outside of that, I think one of the great risks, and it's I guess it could be a positive, but we've seen all too often, and especially in the current environment, businesses of such nature as Ansarada being acquired too early. And when I say too early, that a lot of money left on the table, and more strategic, longer term thinking investors taking advantage of the softer sentiment in the market. And there has been a little bit of talk around over the course of this year where Ansarada was sort of at its lows, that there's a bit of corporate interest floating around, and I'd hate to see that happen to this company, because again, if they've put out pretty specific 3 and 5 year goals for their business, if they execute on that, this can be $1 billion business, and it'd be a shame to see it leave the ASX as a $200 or $250 million business and not enjoy the rewards for the people who have backed it through this period. So maybe it's a risk, maybe it's an opportunity, but that's something I think about.
No, and we have seen not so much in the last couple of months, but earlier this year, we saw lots of takeovers in the microcap space at big premiums. 60, 70, near 100%, I think, for one, or slightly over 100%. Not so much all in a kind of a software-based business, but we have seen microcaps in this kind of bear market, for the want of a better phrase, that we're in, getting taken out by, as you say, more strategic investors and at big premiums. In terms of, you talk about Ansarada's 3 to 5 year view. If we bring it back maybe to the next 12 months, what are you looking for from Ansarada? We'll be getting into half year reports now in February, and obviously full year reports in August next year. Is it kind of the traction that the new products are getting? Is that kind of the key thing you'll be looking for, or is it also commentary from Sam and the team there about what they're seeing in the M&A space to give that kind of real macro tailwind to the business on top of kind of what they're doing in these more kind of growth parts of the business?
Yeah, look, I think absolutely. Again, they quote their freemium numbers, and they've got really big, right? So they've got a large user base now that isn't necessarily being monetized. So for me, the key metric is because there's been pretty exponential growth in those freemium users, and the conversion of those, I think, is going to be a key driver of this, because what you can extrapolate from the freemium users to the paid users is everyone's been pretty conservative at the moment. So I think that's interesting to me. The other really interesting thing, I don't think we can get away from just capital market activity. And again, if you speak to the investment banks, the lawyers, the advisors around town, there's a lot of transactions that were maybe hoping the second half of this calendar year was going to be the time that they get busy. There's a lot of transactions backlogged up, and a few sort of geopolitical and other matters came to play, which didn't see that happen. But I really do believe 2014 is going to be a pretty busy year for that end of the market, and I think I'm really watching for activity to pick up there, because I think this will be the bellwether for that in the listed market. And if you buy into that thesis, this stock could be 50, 100% higher pretty quickly once there's tangible signs of that. But as you touched on as well, it's those new products as well. and what continued traction they're getting. But at the moment, they're still coming from a pretty small base. We want to see them get bigger, but the delta's still around capital market transactions, and I think that's what's going to move this share price over the next 6 months. And again, I'm in the camp of, I think, come the sort of second quarter of the calendar year next year, I think, barring any other geopolitical slips or matters, I think we're going to see quite a lot of activity.
Okay, and let's maybe move on to our second stock. And but before I do, I will say, I'll put a link, as I said to start there, to Sam's presentation from last week in the show notes below if anybody wants to go back and have a look at Sam's presentation. The second one is well, will I say a recent IPO? I'm trying to think when it was. Was it the back end of 21 or early 22? It's kind of been around for 2 years now. Closed the Loop Group, run by a fellow Irishman, Joe Foster. I was good to see a couple of Irish guys having a crack, getting some runs on the board in Australia. Maybe for anybody, and it does keep a kind of a lowish profile, I would say. So for anybody maybe who might have missed the IPO in the kind of back end of COVID, and hasn't really kind of caught up with the story since they've listed. Maybe give us a quick overview of Close the Loop.
Yeah, absolutely. So Close the Loop operates in the circular economy. So it's all about innovative products and packaging that are recycled and repurposed into the environment. And so they play with things from electrical products to printer cartridges to phones to batteries and other things. So they're all about, again, the recycling and reuse of those products. And they've got plants all around the world that collect, process, and repurpose these. It was a business we watched from the IPO with interest because, again, most of the other operators in this space, if you look over the last 5 or 10 years, have achieved great growth through consolidation of the sector, and then ultimately through being acquired themselves by the larger players. So over the years, we've invested in this space quite successfully. So we were intrigued, but the tipping point for us was earlier this year, they made what we believe is quite a company defining acquisition. And that was the ISP tech business, which was in May of this year, which effectively doubled the size of the Close the Loop business. So Close the Loop, just to provide a bit of context around, I'll talk about the acquisition in a sec, but it's $180 million market capitalization. This year will do over $200 million of revenue, highly profitable business. Again, making EBITDA north of $40 million and a healthy NPAT as well. So good global scale business that historically achieved very strong rates of growth, both at the revenue and the earnings line. And again, despite the Irish heritage, a great management team who, since the IPO, look, they've delivered and some on everything that they've indicated to the market. So that's key measure for us. We go back to track record and integrity and execution of management team, and again, hard to fault these guys. But the acquisition they made of the ISP business was fascinating in our front. So the business that they acquired basically has a number of major contracts with the large major consumer electronic businesses like Hewlett Packard and Apple and things like that, where they take old laptops, phones, printers, etc., repurpose them and then recycle them into the market. And they've got some really valuable and exclusive contracts globally with these big organizations. And look, only recently their big major contract with Hewlett Packard in the US was rolled from a rolling 1 year to a 3-year contract. So again, they're getting really attractive margins, good growth in what is a very much a growth sector in the market, because too many of those are ending up in landfill, and as you know, that simply can't continue to happen, and it is actually being legislated to prevent that from happening. And another real key growth driver for this business is get very big in Australia and in the US, does have operations in Europe, but doesn't do the consumer electronic or the electronics repurposing in Europe in a big way as yet. But there's a big wave of legislation coming in Europe that's going to, we think, drive them into that European market in a big way. So again, it's sorry about the lights have gone out here. We've got to make sure we pay the bills, and so again, it's a business that's got good growth, but I think what the market's missing a little bit on this one is, it's hard, especially in these markets. People give a bit of a cursory glance at everything, and this is a business again made a meaningful acquisition earlier this year. The numbers and the integration coming out of that acquisition are ahead of original forecasts. The management from that team staying heavily involved. We've had good access to them as well, and it feels like 1-on-1's definitely 3+ in this scenario, and they're amortizing the goodwill that they acquired with that acquisition, and so that's caught up in the NPAT. So on a face value, it looks like it's on a sort of mid-teen PE multiple, and you think, well, for the nature of the business and the growth, that's maybe a little bit cheap, but not screamingly cheap. But if you normalise it for the $10 million of non-cash acquisition amortization each year, that PE gets down to a 7 or 8 times this year's earnings, and that's the real number, right? It's a cash earnings, cash PE number, and again, I think with the renewal of the big HP contract and the 6 months of data that we're getting post acquisition, I think you really can start baking in those numbers of the combined businesses, even not allowing for the potential synergies both in the growth and revenue. Again, business that's growing healthy double digits, big global opportunity, and trading on a 7 or 8 times PE is just not the right number. And it's a classic microcap that could literally double in share price or valuation and still be reasonably valued. And we do value this stock, effectively closer to 100% of its current upside to its current valuation. So really interesting one. We think it's got all the drivers, and it's got strategic sites, good industry growth, great management team, good balance sheet. Macro trends are very much in its favour, and it's a real global opportunity set. So we're really optimistic about 2024 with this business.
Yeah, and I guess if anybody looked at the results in August as well, given the transaction completed in May, you would have had very little revenue from the acquisition, but all of the acquisition costs would have been captured kind of before June 30, so kind of would have really masked what you were getting on a kind of full year basis. As you say, if you take a cursory glance, you kind of you wouldn't have kind of got the full feel for it. I know they said they're kind of ahead of where they are, in terms of integration. But I guess it might be a bit early to be totally confident there. So I'm putting that down as a risk for now. Anything else you're kind of keeping your finger on there with close the loop in terms of if we just get the counter thesis for a second in terms of risks for the business. Anything you want to kind of call out specifically there?
Yeah, look. Ultimately, what we like about the business is it's quite diversified. Though, if you look through time, these sort of recycling plants and recycling revenues that are earned in various streams are subject to a number of risks, and one being sort of regulation and pricing in the secondary market for whatever material that's been priced off as a benchmark. And then it sounds a little bit maybe odd, but there's quite often site technical problems with the site, or even fire or things like that. And so they're things to always watch, and ultimately it's a processing and service business. It's got some great sites and processing IP and everything else, but it still is reliant on sourcing feedstock, sourcing product it being processed efficiently, then having an end market to sell it. So you've still got all the frailties, I guess, of markets, and then particular plants having any sort of functional problems, and so that's something we keep an eye on. But again, it really has diversified now. Again, with well over $200 million of revenue across dozens of sites, and so there's that portfolio diversification risk. So they don't really have any excessive exposure to one material or feedstock or price. Yeah, not all driven by the oil price or the plastics or anything else. So, but that historically has been a risk for these businesses. And then look, ultimately, again, you flagged it as well. When you make a meaningful acquisition such as the recent one earlier this year, there's just integration and execution risk. Now we're 7 months coming to 8 months into that now. Feels like that risk is dissipating a little bit, but it's still only early. And really you like to see the second year of earnings from an acquired business, because sometimes they can be earnings can be front end loaded, or there might be something that comes through. So we're keeping a close eye on all that. But all in all, again, a cash PE of 8 times this year's earnings, significant growth opportunity, and some real key catalysts on the horizon. We think this again could be a business that has a really successful 2024.
Yeah, so I guess yeah, if we do look at 2024, I think you pretty much summed up the key things to look out for. Is what are the earnings coming through from the acquisition now that they've will have it kind of in play for a full 12 months under the close the loop banner, I guess. And anything else outside of that other than the integration? I mean, is it are you expecting, you said at the top of the piece here on this business or the industry more broadly, it has been one that's had a lot of M&A and, rolling up competitors and consolidation. Is M&A in 2024, also kind of something you're watching out for, or have they kind of said, we've had a chunky acquisition here, we've got to bed this down, and it'll be a while before they kind of relook at the M&A space again?
Yeah, I think M&A could absolutely still be on the radar in 24, but more likely maybe the mid to back end. And so because there is opportunity, because they said they do lots of things across lots of sectors in different geographies, and so if you build out that ecosystem, sometimes to get the facilities and the licensing, I think it is easier to acquire than it is to organically sort of apply and go through that. So look, I wouldn't be surprised if there is more M&A, but for me the other thing to keep an eye on the horizon, I really think there's a real opportunity for them to enter into these, the big HP and other major consumer electronic brands that they have in the US and Australia. Them picking up a major contract in Europe, I think, is a decent probability event, and could be a significant driver of growth. Probably the back end of 24 into 25. So we're keeping an eye out on that. Keeping an eye again on all those risks and the acquisition, everything, but call it the positive catalysts. I really think they've put out guidance, all the way back to, at the start of the financial year, and they've stuck to that. I really do believe there's upside risk to that guidance. So I think we'll probably get some colour of that in the half year result. They've already given us a trading update up to the AGM, and the first half seems to be going quite well. So I think you'll keep an eye on guidance maybe at the February half year result, and then keep an eye out for potentially meaningful contract wins in the European region for the business, I would suggest.
Okay, great. Gregg, thank you very much for coming back in and joining us once again. And yeah, hopefully we can catch up with you at some stage in 2024.
Absolutely. Again, thanks for the opportunity, Mark.